No further comments. Do I have a motion to go with this?
What we're asking is to replace the current benchmark, which is the S&P 500 plus 3 lagged 1/4 with the Cambridge private equity benchmark, and then make it effective for the entire fiscal year, current fiscal year, then going forward.
But he just said, do I have a motion?
So move.
Do I have a second?
I'll second.
Further discussion? All those in favor say aye.
Aye.
Any opposed? Hearing none, the motion passes.
Thank you, ma'am. The next item on the agenda is manager presentations.
Yep, it looks like we're a little ahead of schedule. What would the committee prefer? Take a break, or I need to see if the lunches are ready. I don't, anybody know? Lunches are here. They are. Okay.
Is anybody here?
That was my next question. How soon would they be able to start?
Invesco's here and ready to go.
Okay, so what would y'all prefer? Take early lunch, or?
Yeah.
It's 11 o'clock. They
Rather
didn't
move
fed
ahead.
the nursing
Go ahead,
home
move ahead.
people this early.
Yeah. So we'll go ahead and then do the intro, and then maybe even Invesco, whatever. Okay, all right. That works.
So did you wanted us to cover the manager previews?
Yeah.
Would you mind, do you have them? Do you just want to kind of bring them through, who's coming in to visit with us? Or?
Yeah, I will. So we'll get started with the manager previews. Today is Core and Core Plus Real Estate. So Commissioner Dale, this will be right up your alley. You've got the best and the brightest in the real estate world today to ask. It is mall questions, anything you can think of. Today is your day to ask. Should be a really great day for real estate to ask questions. We have 4 managers coming in. We have 4 Core and Core Plus managers. First will be Invesco, U.S. Income Fund, the J.P. Morgan Strategic Property Fund, the Principal U.S. Property Account, and UBS having TPF and TPG. I tell you what I'll do is I'll go ahead and grab Invesco and we'll get started.
Good to me.
And this will be Layla DaCosta and Dan Kubiak. This is our newest core real estate funds. So this will be the first time that they have presented before the board.
Oh, that'd be fine.
It's kind of crowded.
Come on in, whichever you prefer.
Go, Mr. Sparks.
Yes, you know, this morning, so that we don't get tomorrow.
There you go. Anywhere you want to be, Dan. Good morning.
Good morning.
Welcome to PERS of Mississippi.
Thank you. Happy to be here again.
Please just begin whenever you feel free.
Perfect. Well, I'll go ahead and kick it off. Thanks so much for having us today. My name is Layla DaCosta. I'm a client portfolio manager with Invesco Real Estate. And I'm joined today by Dan Kubiak, who is the lead portfolio manager for the fund that we're going to talk about today. I've been involved with this relationship since it began in 2015, so it's very important to our firm and it's very important to me, and we appreciate it. So what I'm going to be really quick, give you 2 minutes on the firm, and then turn it over to Dan. He said I could only have 2 minutes. So real quickly, if you look at page 6 of the presentation, Invesco Real Estate is a global real estate investment manager. We are not the largest in the world, but we are a top 15 manager. We're large very purposely, and we're global very purposely. We have a very stable platform. We have a very deep management team with 68 managing directors that have been together on average for 15 years, so lots of stability. We manage about $86 billion in assets. We manage public and private. We manage debt and equity, and we manage in strategies across the risk spectrum. We've got a very broad footprint. We've got 21 offices around the world, 5 offices in the U.S. And that's very important for the strategy that Dan's going to talk about today, because one of the things that we do in this strategy is access a broader group of markets, which means having boots on the ground is very, very important. So that's kind of a quick snapshot of what the firm looks like. I'm going to get it right over to Dan so that we can make the 20 minutes that you've allowed us to do.
No. And thank you very much for the time. It's good to see everybody again. I was here a few years ago. It's great to be back. My name is Dan Kubiak. I'm the lead portfolio manager on this fund based in our Dallas, Texas real estate headquarters office for the last 21 years. So I've been here a while, including the last 11 years on this fund. So it's great to be in front of you again. I'm on page 7, which shows our entire fund team. And to Laura's point, I know, we want to kind of keep it brief today. So I'm just going to kind of go through each slide fairly quickly, hit 2 or 3 points, but please, interrupt if you have any questions, or, I'll definitely leave time at the end of the presentation to answer anything that you might have, but definitely appreciate being here again today. If you flip to page 9, just a really quick reminder of the fund strategy. It's an open-end, perpetual life, core plus private real estate investment focus. Our goal is to produce premium income and total returns versus the core private real estate benchmark, which is called Odyssey, ODCE, or Open-End Diversified Core Equity Index, put out by NCREIF. As the page indicates, we've got a long history in the core plus space from the early 90s as a firm for the last 11 years in this fund. And we do it with a diversified portfolio. We focus on things like demographic, secular, and economic trends within the portfolio to produce something that we think is rather distinct relative to your core real estate holdings. So broader sector exposures, broader market exposures focused on the Sun Belt, premium income, things that are very complementary to your existing core real estate attributes. So it's something we feel like we've done very well, and we'll get in, right into it in terms of the performance of the strategy in a second. But page 10 also gives you a little bit more definition on, we say things like broader markets, what does that mean? And it's very demographic driven. We're looking for, younger demographics, growing demographics, population growth, quality of life. On the economic side, looking for business-friendly environments, kind of lower cost of living, low regulation, good job growth, affordability, et cetera. And you can see on the left side of the page examples of those markets. And again, 80% plus in what we would label the Sun Belt market, South and West U.S. markets. And same thing on the left side in terms of secular trends impacting the sectors that we pick. And you can see 90% plus in the residential, industrial, and specialty sector side. Very significant underweight to the office sector, only one office investment, which is 100% leased. So that's something that's really been a tailwind to our performance. But this page 10 gives you a little bit more definition on the strategy portfolio construction. Page 11 highlights just the real estate market opportunities that we see today. I think our hope is that interest rates are finally stabilizing, albeit a little higher level than they were several years ago. Property fundamentals are moderated, but still positive. All of this has really played into our specific strategy in terms of having premium income really insulates you somewhat from other strategies that have lower income returns as interest rates rise. We've got a lot of growth built into our portfolio relative to the sectors and the markets that we picked. We've got a really strong balance sheet that's enabled us to kind of take advantage of things and the disruption we've seen in the markets. And we'll get into that here in a second in terms of where we've been focusing for new investments lately and some of the fundraising commitments we've gotten. Page 12 gives you a quick snapshot of where the fund sits today. And hopefully this illustrates a little bit to you in terms of the stability and the growth of the portfolio, good diversification by number of investments and size. Portfolio is very kind of core, stabilized in nature, good occupancy, good income growth, good stable dividend. Balance sheet is in good shape in terms of lower leverage, lots of fixed rate debt, not a lot of floating rate debt, all very intentional. On the right side, you can see steady, stable growth over the last 5 years or so. On page 13, performance, which we know is very important to everyone, you can see how the fund performance compares to that core NCREIF Odyssey benchmark that I mentioned earlier. You can see the fund is kind of in the blue shade in the chart. The index is in kind of that green shade. And you can see, depending on whichever time period you look at, outperformance by the fund over the index over all time periods and by both the income return metric and the total return metric. And again, this is thanks to several factors in our portfolio construction, including the premium income returns, which you can kind of see in the darker colors within the chart. It kind of gives us that head start on total returns. And then when you mix in the growth that we get from our specific sector weightings and market exposures, it helps us outperform over all those time periods. And, when you look at the time periods, kind of the years 3 to 10, we've generally done kind of 7 to 10% returns, which we've been happy with. The last year has obviously been a little bit tougher given, again, not negative fundamentals in the portfolio, but more the rising cost of capital and rising interest rates, admittedly coming off of a couple of pretty strong years post-COVID of like 20% plus. However, we see valuations, and we'll go into this in a second, are starting to somewhat trough. So we think a lot of the negative returns are hopefully flattening out. We'll hopefully see some positive returns for the balance of the year and kind of gravitate back to that 7 to 10% that we've seen the fund's been able to do historically, which is a meaningful premium over the benchmark, which has been somewhere between 3 to 7%. The next several pages I'll go through pretty quickly, which will hopefully just emphasize a few of the points that we made earlier. Page 14 highlights the sector weightings that I referenced and just briefly explaining it. On the left side, you'll see our sector weightings as the fund in 2020. On the right side, 2024. And in the middle, that gray shaded area is the index. So you can see a meaningful overweight to the residential sector, which has been helpful, and we've grown that. We've diversified it within product types. Second largest weighting is in industrial, and that's actually closer to 30% today with some closings I'll show you in a second. And then on the far right side, you can see the significant underweight to office. Again, only one investment, 100% leased, and that's been a tailwind to our performance. Page 15 illustrates some of the market exposures I talked to you about in terms of, the demographic economic focus on the Sunbelt region. You can kind of see it in terms of the weighting, almost equally split between the West and the South, 80% total, where the blue dots are, and you can see kind of the green shaded states are the ones that have top quartile growth. Again, focusing on those markets that can really help our performance. So hopefully that illustrates it a little better. Page 16 highlights our operating portfolio growth. And again, this will show you that, the slowdown we've seen lately has just primarily been an increased cost of capital slowdown. Fundamentals still remain positive in the portfolio. You can see on the far right side of that chart, we're expecting to grow our income within the portfolio close to 6% this year on a core stabilized basis portfolio. So, lower risk, but good growth. Historically, you can see on the right side of the page, we've grown it close to 4.5%. So that's been positive for us. Page 17 on the top chart within here, we're looking at our fund valuation summary. And you can look on the top chart on those two right-hand columns. You can see in the fourth quarter, Write-downs were around 3.8%. They decreased in the first quarter down to 1.7%. And we're going to see those hopefully get about half of that number in the second quarter. And so going towards that flattening out this summer that I was referencing before. And then the bottom chart on the left side illustrates the premium income within this portfolio relative to that Odyssey Index benchmark, which is in the left column there at 4.68% versus this portfolio, which is year one to stabilize to 5.1 to 5.6. So that's that premium income that's really been helping our portfolio on a relative basis and helping somewhat insulate us from higher rates. Page 18 shows our balance sheet. Again, in pretty good shape. The bullet points on the right side of the page, I think, do a good job of summarizing what we've been doing on this front. It's been a real strength. We fixed a lot of debt back when it was attractive. We don't have a lot of floating rate debt. We lowered our leverage down over the last couple of years as we saw some of the valuation impacts coming from the low 40% LTV down to low 30s where we are today. We buttoned up all of our 2024 debt maturities through either extensions or just flat out payoffs if we thought that was the best thing to do. So this has been a real strength for us. In addition to the liquidity position that we're noting on page 19, you can see in April we called in over $100 million of capital from investors and we redeemed out only $35 million. In terms of where we sit today, we've got between signed and documentation a little under $120 million of capital coming into the fund versus $60 million in redemption requests, which is primarily all from one investor that really needs liquidity, so it's not performance related. So we have net positive inflows coming into the fund. We recently received 2 important verbal commitments that we can't outline the names yet, but one from a non-U.S. investor that was sizable, and then one from a top 20 U.S. pension fund that's located a few states away from here that we look forward to publicizing once we get it all signed up. But it's an endorsement, again, of the strategy, the performance, and what we've been doing in terms of executing within this cycle. And then the last page of the prepared remarks, page 20, just shows you some of that acquisition activity that we've been doing over the last 6 to 9 months. As we've been well capitalized, we've been able to take advantage of other groups that need liquidity and need to sell assets. This represents somewhere around $300 million of acquisition investment activity, continuing to grow that industrial weighting that I talked about. You see on the left side of the page, growing our residential weighting. It's highlighted on the right side of the page, which is what we'll continue to do with this new capital that I referenced. We got the verbal commitment from. So page 21 kind of closes us out. That concludes our prepared remarks. I know it was kind of a lot of information in a hurry, but I wanted to make sure we left time for any questions. So while it's been a little bit choppy over the last year or two, we still think long-term that our performance is headed back, hopefully over the remainder of the year, back to where we've historically performed with the fund. So with that, definitely appreciate the opportunity to speak with you today and happy to answer any questions we can help with.
Do we have any comments, any questions for these gentlemen?
Dan, I'll ask, real estate has had a lot of headwinds here recently, and some attribute to interest rates, different reasonings. Can you speak to what y'all see the biggest reasoning for this downturn has been, and what will be the catalyst for the upswing? Will it be interest rates, and what do you see as for the timing of that?
Yeah, no, it's a good question. I mean, clearly, interest rates were abnormally low for a period of time, and that incented a valuation increase, substantial valuation increase. And honestly, I think, some groups were probably, taking too much advantage of that, maybe a little bit too much risk, floating rate debt, over leveraging things. And as we've seen interest rates rise back up to maybe more, longer term normalized levels, we've seen some of those groups get caught. So I think as you kind of see the tide go out here, you can see which groups, were kind of behaving and executing responsibly, and which groups were maybe a little over their skis. And in terms of the go forward, I mean, I think a lot of it will, at least we're banking on a lot of it just being operating income growth, having the right sectors, the right markets to block and tackle and grow your income and drive value. It's not going to be like maybe past cycles where you had significant decreases in interest rates, or at least that's not what we're banking on. We're banking on operating, the right portfolio and growing income, and that's what we're going to drive value from.
And Jason, I would just add that 500 basis point increase in interest rates over 9 or 12 months is going to leave some damage in a real estate portfolio. But to your point about what's in the papers, so much of that has to do with office. And office is a much smaller part of the entire universe for both your core funds, and we have almost none of, only one building here. But even in the broader real estate markets, office exposure is a much smaller part. We've expanded it. Everybody's expanded into areas like medical office and data centers and, senior housing and all those kind of things. So you have to pay attention to what you read, and if they're focused on office and not paint the entire industry, with the same brush.
Question, without being political, the effect of this being an election year, having it on the philosophy of investors moving forward?
Yeah, I mean, you want to start with that one and I'll.
We have not, well, first place, there's not been a ton of investors moving forward. I mean, it's been slow capital raising period. I would say maybe a little bit of it, but it's not become a broad reason not to commit capital recently. We
Yeah,
have not seen that. I think we see a bigger driver being the opportunity that investors see today with real estate having been significantly repriced. That is kind of a little bit more powerful, I would say, than concerns about the election right
Yeah,
now.
I would echo that. I think investors really like our strategy, but we were happy to see these two recent commitments because I think it's an endorsement that they feel like our fund valuations have largely gotten to where the public markets are as well. So they wouldn't be buying into the fund if they felt like it was overvalued. So that's also what gives me a little bit of confidence about our forward returns as well, as we have our valuations adjusted, and rightly or wrongly, we kind of ask our investors the same question about the political front, but the answer we get is I think they're kind of, unfortunately, I guess, used to this environment by now, so it's not anything that's holding them up if they find something that they, are convicted about.
Thank you.
You bet.
All three manufactured housing parks. I assume the return on those are, our area, we try to get rid of manufactured housing parks. Local politics of that, so just curious as to how that.
Yeah, a couple things. I guess we like residential broadly in terms of having an overweight with it, but we like diversifying that within, several different types of product. And the concept you're kind of talking about there is one of the reasons we like it, is it's somewhat supply constrained. It's hard to get kind of new parks approved because, rightly or wrongly, there's sentiment in certain locations about adding more of it. So it tends to be supply constrained, and it really helps us better operate the ones that we have because we know there's likely not going to be a multiples amount of new supply immediately around us for that reason.
And part of the opportunity is to apply truly professional management to parks that have been owned by individuals that may or may not have been properly capitalized in the past to keep it up to the standards that you would want in your community.
Well, thank you, gentlemen.
Yeah. no,
Well, thank you
Yeah.
again for being a partner for as long as you have, and thanks for having us today.
Yeah, thank you very much.
Break now for lunch. Don't break for lunch now.
Are we gonna break for lunch now? Or, oh, okay.
Do we want to squeeze in one more?
That's okay here, yeah,
That's
certainly,
good.
whatever y'all prefer.
Let's squeeze one more in.
Okay.
And next we have JP Morgan with Jeff Fox and Brian Nottage.
Get going. All right, well, just want to start. My name is Jeff Fox. I'm a client advisor, run the public funds effort for JP Morgan. Been here next month 24 years. Been working with Mississippi PERS for over 20 years. So we really do appreciate the support and the relationship with you guys. Today we're here to talk about our core real estate product. Brian Nottage is one of the portfolio managers, been with us for 20 years. Obviously, we've had some turnover in people, and we want to address today where we are, where we've been, where we're going with our core fund. But we want to acknowledge that, A, we've had some turnover in people. If you have any questions on that, we can address that. But we are a deep organization with phenomenal resources. Brian, Sue Colasso, and Caitlin have been with us for a long time, and we're pretty confident in where we're going with the fund. So I'll turn it over to Brian. We have 15, 20 minutes. Make this interactive if you have any questions. And as I said, thank you for your time.
Yeah, thank you. So I'll start on page 14 to talk about the fund. And there's really kind of two things I want to leave you with today. So I want to talk about, in a very transparent way, the performance of the fund and some of the challenges that the fund has had, and really pinpoint why there's been an underperformance and what we're doing about it. It's different. So I want to anchor you with that. But I also want, if you look at the top of page 14, I want to also talk about why you all have been invested in this fund, which is that we think we have the best set of assets of any fund in Odyssey in terms of quality, and that you're able to see that in terms of the performance of the assets. So the challenges that we have had is not because we don't have great assets, it's that we've sometimes had trouble putting all of those together in terms of allocation. So I'm going to talk about those two anchors and then what we're doing about it. So if you go to page 15, one of the things that we have spent a lot of time doing over the past 6 months is getting a very detailed asset-by-asset plan in terms of how do we think about the fund going forward in the next 2 years, the next 5 years, that sets us up for outperformance. And so our 24 and 25 plan is on page 15, and there are 3 pillars to this. And each of these are equally important. And they address the performance of the fund. And I just want to just say a second. So if you looked at there's a page that gives you the 1, 3, 5, 10, 15-year performance of the fund. And you might look at a 10-year, and you'll see a number in terms of a gap. I'll just say that SPF has had, sort of 3 periods of performance. For most of its life, SPF has been a very strong outperformer. The very most recent period, over the last 7 quarters, where there's been a repricing, it's been a really tough time for SPF. And then kind of in the middle, there's been a period where SPF has had modest underperformance. So there's been a modest underperformance period that's sort of gone on from 2017, 2018, and in the last 7 quarters. So what I want to do is I want to address those 2 periods, tell you why they've happened, what we're doing that's different, and why we think that turns around. So page 15 talks then about our plans going forward for performance. So the first thing on the left is talking about allocation. So if you think about SPF, this has been a great set of assets, but at various points, we've just been off sides in terms of how our portfolio has been put together. So we've had at some points too much retail, or we've had too much office, or not enough industrial. And as a result of that, what's ended up happening is that has led to some underperformance. That's been sort of a modest underperformance over time. So a very large part of what we have been focusing on, and this is not new, is continuing to fix that allocation issue. And you can see what we're doing. So we're reducing our office and retail. By the way, we've been doing this. So we've been doing this since 2020. So we've sold since 2020 $5 billion of office, $5 billion of retail. It's just that we're looking to finish the job. And I'll talk about how much we want. But we basically want to get to a fund that is sort of 70% residential and industrial, and kind of 30% office and retail. So a shift in sort of what we're doing. And as we're reducing those sectors, we really want to lean into the sectors that are the growth engines of real estate. So new extended sectors that we really leaned into, like builder and single family rental, where we were the first mover in, like truck terminals and outdoor storage, where we were the first mover in. These are sectors that right now are about 10% of the fund. We want to be about 20% of the fund by the next 2 years. So that's a very important part of the story, which is allocations have been an issue. So by reducing office, reducing retail, increasing our exposure to these extended sectors, that is a very large portion of how we think about fixing that underperformance. On the right, as we do this, the thing that has defined this fund since its inception is that our assets have generally been better. And they've been better, there's a whole bunch of ways you look at it, but our assets have typically outperformed. Meaning, if you went in any particular sector, you said, I want to look at office. Our office assets would typically outperform office assets of the benchmark. You look at our retail, that outperform. So the mix wasn't necessarily right, but the assets were. Kind of give you a sense of that. So if you looked, for instance, at our retail, our typical strip center, if you just look at the revenue per square foot, is about 20% higher than the Odyssey peer set. Our malls, our revenue per square foot is 70% higher than the peer set. If you look at our industrial portfolio, which is heavily Southern California, 40%, it's coastal, it's port-driven, it's infill. When we sign a new lease from an old lease, our rents go up by 70%. For the peer set, that's about 40%. So we have a lot of embedded growth that goes into that. Even in office, so office has obviously been a huge struggle. If you looked at our office assets, we've done over 2 million square feet of leasing over the last year. If you went and you looked at our office, basically rents versus the rest of the peer set, it's about 40% higher. So we have a really high quality portfolio. And so as we're shifting our allocations, what we're focusing on very much is that right-hand side, which is making sure that we keep a high quality portfolio that continues to outperform. So as we're selling assets, we are making sure that we're selling non-strategic assets from the bottom. And then in the middle, we're focused on liquidity. So we have a large queue. All of Odyssey has a queue. So all of Odyssey's been falling for the last 7 quarters. All Odyssey has a queue. We're looking to do $2 billion in pure redemption payouts in 2024. And we did $500 million in the first quarter. You're going to see we're going to do $400 million for the second quarter. So we're on pace to do that, and $2 billion in 2025. And we also have a fee credit program that's generated a large number of rescissions. So we are looking very aggressively to reduce the queue as we fix our allocations while we maintain the asset quality that we've had. So that is really our 2024, 2025 plan. So in the next couple of pages, I want to take you through in some detail what the challenges have been and sort of how we think about moving that around. So if you look on page 16, this shows our performance over the first quarter. And over the 7 quarters of the correction in real estate prices. So in the first quarter, you can see that we had a minus 5.5% return. You can see the sectors in terms of how much prices fell down. So you can see for office, for instance, 12.7%. 70% of our depreciation in the first quarter was office. We've, over the last couple of quarters, really moved this portfolio to mark our values to market. And you can see on the right, if you looked at the entire 7-quarter repricing, we're down 22% on an unlevered basis. We're down 24% on a fund basis. And you can see by sectors, we're down 40% in office, 18% in residential and industrial. These are big numbers. And I will say that for office and industrial in particular, they are much bigger than the peer set. So we think we have better quality assets, and we've marked them down further than the peer set. And I'll show you a chart that shows that as we're selling, we're actually selling at values that validate these numbers that we have here. So that's big numbers, right? Those have been big declines. And I will say that that's been an underperformance in the 7 quarters. If you look on page 17, just spend some time talking about what drove that underperformance and how do we think about going forward. So there's a lot of numbers on page 17. But if you look on the right-hand side, you can see that bar, that's our minus 24% return over the last 7 quarters. If you look at the bar to the left, that minus 16.8, that's the peer set. So you see that 722 basis point gap, which is large. So what's driving that, and how do we think about that going forward? 90% of that underperformance is driven by 2 things. It's driven by having larger write-downs in industrial, and it's higher leverage. Those 2 things right there explain 90% of that underperformance. And you can see that noted. So the way to think about this is when you look at each of these individual things, if they're red or green, this is did they contribute positively or negatively relative to the benchmark. And you can see that even though office, for instance, has been a negative, look at our retail. So our retail, which was a bad thing in 2020, has really been an offset to our office. The challenge has been, for instance, industrial. So if you look at the top, if you look at the right-hand side, we've written down our industrial assets by 18%. The benchmark is written theirs down by 11%. We don't think it makes sense. We don't think that that reflects where market is. And so we think a couple of things have to happen. Either the rest of the benchmark has to catch up, write things down more, or more likely, as prices start to come up, we're going to get a lot more uplift there. And importantly, when you look at that leverage portion, So we have about 350 basis points more leverage than the benchmark. That's hurt us in this downturn. That will help us. We'll get that back in the upturn. So the way I look at page 17 is this is very much also a go forward chart. This explains where we've been, but as we get the industrial marks back and leverage is a positive, this is a recipe for over the next 12 to 18 months starting to outperform. And page 18, I just want to speak to, because this really does speak to when we talk about the marks that we've taken and the marks we've taken relative to the rest of the benchmark. That's because we've sold a lot of assets. So in the first quarter of this year, we sold $900 million of assets. We sold an additional $400 million in the second quarter. We are very active in the markets, again, selling non-strategic assets. So this chart is very telling about where we're marked. So if you look, this is in the first quarter. There are a lot of numbers here, but what I want to show you is, so if you look at that left-hand side, this shows how much over the quarter did values decline for assets that we hold versus assets that we sell. You want those things to be similar. So if you look, our held assets fell 5%, our sold assets fell 4%. So basically, how much did you have to cut your price in order to sell it? Very similar. You look at our peers, a very big gap. Held assets fell by less, and sold assets, you had to cut 15%. It isn't simply a one quarter thing. If you look at the right-hand side, this is where the rubber meets the road. At the end of the day, over the last 7 quarters, our sold assets have declined in value exactly as much as our held assets. And if you look at the peer set, you see a massive gap. Held assets fallen by less, sold assets fallen by more. This is important, not just because it's good to have your assets marked to market, but this is a path to liquidity. So we talk about reducing this queue, getting you money back. This is a path to liquidity because we don't have to cut prices 50%. We don't have to say we're going to take this massive write-down in order to sell. So that's how we feel confident that we're going to be able to generate liquidity, that we've taken the marks already that let us do that, and that as we get sort of this recovery, that we're going to have a very strong story in terms of getting back some of those industrial marks that people haven't taken, getting our leverage, and that we're also doing what we need to do in terms of fixing allocations. If we turn to page 20, I just want to highlight a few things here that I think are important. You know, I've talked about the quality of our portfolio. So again, what we're doing in this portfolio is we're saying we are very focused on that top left, which is making sure our asset allocations get to where we think the future of real estate is going. So that sort of 70% in these demographically driven residential, industrial, 30% in retail and office. I will just note, by the way, our retail, so we're overweight retail. We're going to reduce our retail. We're going to always be overweight retail because we do it very well. Our typical mall is a $1,600 square foot sale product. People in Odyssey are going to have to increase the amount of retail they have. We're going to be reducing from our worst retail as people are buying. So, you know, we feel good about that. But on the top right, this is what talks about the rubber meeting the road, about what our assets have done. So this is, if you looked at our assets within each sector and said, how do your assets do within each sector? Do they underperform or they outperform? Our assets, you can see, these are annualized excess returns. You can look over the 5 years, for instance. So if we'd had the exact allocations of Odyssey, without even leverage, we would have outperformed by 160 basis points. So our assets work. The things that we have absolutely work. What we're doing is we're finishing the job in terms of allocations that we started in 2020 in terms of the sales. And that is fundamentally how we think about a fund that turns around the underperformance that we've had structurally and gets us to outperforming. We have the right assets. We're moving towards the right allocations. This is something that will be done in the next 12 to 24 months. And that's also as we're able to provide liquidity at the same time that we think is going to be more than the rest of the index. You know, so there's, you know, we have information on 21 on the balance sheet. We can talk about it. I will say that this is a very, in terms of our balance sheet, this is very strong. We don't have many debt maturities coming up. The extent that we have debt maturities, they are generally taken care of. So you can see on the top right, we've had 3 big maturities in 24, all of which have been taken care of, all of which positively. I'll just note, North Park Center, for instance, is a mall in North Dallas. So you might think, how does retail price these days? We got money thrown at us to refinance this mall. And we got pricing that was similar to a multifamily asset. It tells you sort of how high quality retail has now sort of come back in favor. If you look at the bottom left, almost all of our debt is fixed or hedged. Right? So we are not exposed to a large amount of interest rate risk. And if you look to the right and you look at our outstanding debt maturities, we've taken care of 24. In 25, most of what's coming up are fund level debt. So they're private placements. They're term loans that are coming up. And we're already in process of sort of moving those along. So we feel very good about the strength of the balance sheet. And we feel very good about the ability to execute our continued sales, to get that $2 billion this year, that $2 billion next year, to continue to move our allocations where we want to go, and to maintain, I think, the quality of the assets. And again, that's what you really bought into, right? That's really what's been the North Star of the portfolio. So why don't I stop there?
Just quickly, though, you mentioned that we wrote down assets more than the competitors and we have more leverage. So when you guys underwrite the portfolio now, going forward, just quickly, where do you see returns going then?
Yeah, so we, over the next 3 years, we think that we're going to have an annualized kind of 13 to 14% return. And we think that's not only good, but that'll be an outperformance to Odyssey. And the way we sort of put that together is that we have on stabilized assets, we have about 5% stabilized yield. We have, over the next 3 years, budgeted almost 6% NOI growth. So from the properties, that's actually less than we've had. So we've had much higher NOI growth, and we're seeing very strong trade outs in our industrial I've talked about. We're seeing residential, like our single family rentals. We're seeing accelerating rent growth. We're seeing 5 to 6% rent growth there. We're seeing in retail that we're getting trade outs of 20+% when we get new leases there. So we have very strong NOI growth. We have a development pipeline that we shrunk, but is bigger than the rest of Odyssey, particularly in industrial. That by itself gives you about 80 basis points a year. And what's great about that pipeline is we shrunk it, but it's an accordion. So as we get more money, we're going to be able to ramp that up. And that we think is a real advantage. We've used development not to juice returns, but to actually get where we want to be. So that's helped us get industrial in great locations that's new. It's helped us do single family rentals, not scattered sites, but building new purpose-built communities. And we've actually gotten, we've gotten a real benefit from that. And then you add the leverage, we get to the 13 to 14. It's not crazy. If you looked after the GFC, the 3 years following that were about 15% returns for Odyssey. So we think that is a very credible number, reflecting a recovery. You don't need a whole bunch of interest rate movement to get there. And again, that will be as we've moved our allocations to where we think they need to be to say that our assets then are what let us outperform.
Any questions?
Brian, you mentioned the significant write-downs in SPF, and everyone has seen them. But for SPF, can you explain to us how those write-downs are determined and why so much more relative to peers?
Yeah, so our process evaluations is independent, so in several ways. So for instance, as portfolio managers, we have nothing to do with evaluations. We have a separate valuation team that doesn't even report up through the head of real estate. And they in turn rely on external appraisers and an external valuation process. And our external valuation company is different than what most of the peer set has. So our external valuation company, which is Citus, tends to focus very much on, I don't need to have comps necessarily. I see the world's changed. I'm going to make sure that our discount rates have gone up, our exit cap rates have gone up, because that's the way the world is, right? And so they've been much more aggressive in marking down assets. For instance, an office, even if office isn't traded, which by the way is the right thing, right? If you say nothing's traded in this, therefore prices haven't gone down, that's probably not right, right? So, and if you look, for instance, at Altus, which does most of our competitors, they're much more loose about that, and they're much more willing to go, until we see a comp, we're not going to write things down. So I always hate the blaming the refs, because it feels a little bit like you're blaming the refs in terms of what's happening. I will just say it is philosophically different. And I will also say, to the extent that we have had any influence on our appraisals, what we've said is we want to be at market, that we are not looking to keep values up. We want to reflect market so that we can get liquidity. And so that's been a difference. And I will say, I think that if rates don't come down, you're going to see a big gap in people who can sell and people who can't sell. Because you're not going to get bailed out by lower rates if people are saying, give me the money back. So that's really been a big difference. And again, I hate the blaming the refs thing, but that's part of it. But it has been deliberate because we want to make sure we're mark to market. We can transact.
Brian, so you've got a redemption queue of about 7.3 billion, right? And net asset value 25. Raising 4 billion over the next 2 years to mitigate that redemption queue. Can you just, I think you touched on this in terms of navigating new opportunities and your ability to take advantage of that. That's certainly, you're hamstrung to a certain degree, but given the quality of your assets, right? How do you navigate that? What does that timeline look like in terms of being able to avail yourself of new opportunities?
Yeah, so it's a great question. And I will say that even as we're addressing the queue, and one thing I will just note is, so we have an incoming queue. So we have a contribution queue of $700-something million. We've actually taken in about $285 million this year. I think after the second quarter, I think people are going to have a sense that the market has bottomed. I think we'll get more of that. So that's part of the story. Our credit program, so far, we've had about $1 billion that have committed to coming off the queue. So that's also helpful. But
That's going to be towards new flows as well, John.
That's
So if you come in new clients or you add additional flow, you're getting the 30% discount as well.
That's right. But even as we've been doing this, we have focused on continuing to invest in the sectors that are for growth. So for instance, just in this quarter, we committed $60 million to new build-for-rent single-family rentals. We've committed to new industrial outdoor storage projects. So the way you think of our budget is that we have about $400 million earmarked in 2024 for investments in those extended sectors that we believe in, even as, so we have the $2 billion. That's also, that $2 billion is separate from saying we're still going to invest, because fundamentally, what we have to do at the end of this, when we start on the other end of this, we have to have a portfolio that we believe in that performs, and that does mean fundamentally investing in the sectors that make sense and where there's great opportunities. So if we had more money, we'd be spending more. But what I can tell you is we have $400 million, we've already spent $60 million, that we are absolutely doing in the sectors that we think matter.
Thank you.
One of your slides here talks about the retail. Do you think the brick and mortar stores are coming back into are getting back in favor again?
So it's interesting. Retail, I will tell you. So retail has been something that during COVID, I was so thrilled because I didn't have to go anywhere, and I thought that everyone would be like me and never actually go to a store again, and it turns out that's wrong. So retail is kind of two retails. Retail is not actually doing well. So you take sort of an average kind of retail store, that's still being killed by Amazon. That's still being killed by a lot of things, right? The retail that's working is retail that has experience with it, that has services, has restaurants, right? It has stuff that you can't get necessarily online, that gives you a reason to go out. So when you look, for instance, at our malls aren't simply, hey, here's a collection of shops with some air conditioning kind of going. Our malls increasingly are indoor, outdoor, where you have these lifestyle components, where there's tons of restaurants, where you're walking around, where it becomes an experience, not simply going out and buying something you can buy online. That's the retail that's working, and I would tell you it's working more than I would have guessed. So I'll give you some numbers. So relative to 2019, pre-COVID, our traffic, our sales, and our net operating income are up everywhere we have in our retail. So our net operating income is 20% above where it was in 2019 in our retail. That I did not have on my bingo card, that it would be doing that. And I talked about when we renew, we're sort of 20%. So the very best retail that's experience focused on the one end, like in the malls, and retail that's very much like grocery anchored, necessity retail, those are the two things that have worked. So grocery anchored in good areas, that's worked. Very experiential retail in sort of the best malls, that's worked. There's a whole middle that still has to go. So, retail is really, really two stories. And I will just say the one thing about that I think is interesting is as we reduce our office, there's a little bit of that going on in office too. So there's no single office market. There's some office assets that are doing really well. Most office assets are not, but you're seeing a little bit of that go on too. And I think you'll see that play out over the next couple of years. So we're selling our office assets. We're selling assets that we absolutely do not believe are the future of office, but what we hold, we think are the things that people are going to want to work in. So it's kind of a very similar story.
What is the future of office?
Look, I think that hybrid and work from home is real. I think that people who downplayed this have been absolutely wrong. And I think it matters also that if you're willing to work 3 days a week, you'll accept you'll accept less space, for instance, than you otherwise would have if you had to come in 5 days a week, which, by the way, I have to. So not that I hate it. Of course, I'm thrilled that I'm coming in 5 days a week, but that is not what everyone is going to be doing. I will say that what's happening is we're seeing this incredible flight to quality where you have buildings that are very nice, that are modern, that you can stuff people in, but it doesn't feel like you're stuffing them in, so it tends to be newer. Those buildings, not only are they leasing, they're getting very strong rents. So corporations are willing to spend up money on those, sort of saying, I'm going to have you come in, I'm going to sort of have you have a reason to come back to the office. Typical office, and this is across the country, by the way. So 15 years ago, if you said, what's the best play in real estate? I'm going to buy a Midtown Manhattan office building, and I'm going to sit on it, and it's just going to make me money over time. And it turns out that doesn't work anymore. You have to put tons of money into that. People don't want to be in those buildings. That stuff is dying and is dead. And you'll see every time you see in the Journal or something, oh, here's a building that's going for $80 a square foot in auction. That's that type of office. There is a portion of office which is very high quality, tends to be newer, where corporations want to be. That works. But I will tell you, that is a much smaller share of the office stock than it was 10 or 15 years ago. And I think that continues to shrink. So the investable stock of office is lower. There is no question.
So if it's not Manhattan, where is it at?
So I will say that, so Manhattan, I think, has its places
Okay.
and its particular buildings. I'm saying you can't have, if you sort of threw a dart in Midtown and said, find me a building, that dart 20 years ago would have made you a lot of money. You can't do that. You have to really do a rifle shot. Here is the particular spot, whether it's Hudson Yards or whether it's, right now at Grand Central, just so you know, with a building that is kind of 10 to 15 years old, no older, because you can have the efficiencies that you don't have otherwise. That's what works. And in every city, you have those locations and those sorts of assets. Those are the assets that work.
What about Texas, Miami, Tennessee?
Yeah. So Miami's an interesting place. So parts of Miami, as you've had a lot of movement, particularly finance from New York, that's been something that's been good. And then in places like Texas, so we have investments there. You have to be careful because there's a lot of supply you can build. What we're seeing in all of those sorts of places is that what people want is sort of cooler spots. So like in Tennessee, Nashville, people don't necessarily want to be downtown in a tower. People often want to be, near the river. And so, there's these cooler sort of industrial type offices. We've done the same thing in Dallas with East Quarter. In Miami, it's, Wynwood. These are all the sorts of, they're cooler things. And it's kind of funny. They're cooler not because they're tech tenants. It's like banks want to be there. Like insurance companies want to be there. Because everyone wants to go, we have a cool place. Our employees want to go there. That's kind of the offices working. Cooler spots, basically, generally you have some good transit. You generally have stuff around it. You can go and you can find a place to eat, right? You can go and you can do something a little bit after you go from work. That's the stuff that works. So that is kind of office throughout the country. And that's almost, that sort of model, you can sort of plunk that into almost every market in the country and say that's the sort of stuff that works. Does that answer your question?
All right, well, thank you for your time.
Thank
We
you.
really do appreciate the partnership and support, and have a great day. Thank you.
Thank you, gentlemen. Lunchtime.
Break for lunch? 1 o'clock? Or- Yeah, okay, all right.
Do we need
John, take notes on it.
Well, who's gonna answer all these questions?
Everything. I despise flying, just for that reason.
Hey, George, you be answering all the questions.
You ask questions when you don't know nothing.
Everybody needs to have one of these tattooed on their hand.
Good afternoon.
Are you? Hello.
Welcome.
Thank you.
To be aware.
Ooh, that's the most dangerous thing in the world.
It is.
Matter of fact, make sure it's red.
Yeah, you ready?
All right, next we have Principal U.S. Property Account. We have Darren Kleiss, Portfolio Manager, and Greg Pittenger as our Relationship Manager.
Thank you. You all have the decks, I think, in front of you, so thank you. We'll start with page 4. Again, my name is Greg Pittenger, Relationship Manager with Principal Asset Management based out of Raleigh, North Carolina, and thank you for having us here today in your business. This slide covers the Principal Real Estate platform. We've been managing assets for public fund investors like yourselves for the last 60 years, so you're in good hands on that front. I'll point out to a couple pieces on this page. Over 320 real estate professionals with over 14 years experience with the firm, going through multiple cycles, important in this environment we're in right now. Today we're going to be talking about our actively managed pure core real estate portfolio that we manage on your behalf, high quality assets invested throughout the United States. Last piece I'd cover here on page 4, we call this our 4 quadrants. You'll see about $50 billion is invested in the private equity core real estate and opportunistic side of the equation. That's the top left kind of royal blue chart. But one thing that this brings some value to all of you as investors is we manage assets across the private and public real estate space as well as in the debt space. And so environments like this where you have some interesting debt environment, it's advantageous that Darren and the team get to share ideas across the platform with their debt colleagues. So that is just a brief overview of Principal Real Estate. Given we have a short amount of time, happy to answer questions throughout if any of you have it. Otherwise, we can turn over to Darren to talk about the portfolio in some more detail.
Thanks, Greg. We can maybe jump to slide 9 in the materials, which gives you just some real high-level view of where the funds sit at the end of the first quarter. The fund sat at just under $12 billion of assets and 150 properties. And just as a reminder, we're in the business of owning direct real estate. So we're in the landlord business. We're not buying stock in real estate companies. We're not lending money to other people. We're in the business of owning properties and operating those properties. Give you a sense of the portfolio here on a 42 million square foot portfolio. As you'd expect from a core fund, it was 93% occupied, very good occupancy number. Anything in the 90s is strong. Another number we pay a lot of attention to is our 1-year net absorption, and that's the amount of square feet that are leased in the portfolio today that were not leased a year ago. So that's 650,000 square feet of new tenants have moved in the portfolio, and they'll start paying rent if they haven't already very soon after a free rent period may have expired. So good track record of growing income within the portfolio, and we've got some statistics on that a little bit later. Update on our contribution queue and our withdrawal queue. We've got, at the end of the first quarter, we had $612 million of new investment waiting to come into the fund. And since the last time that we presented to you about 2 years ago, we had decided to stop calling new capital into the fund, just as we saw our repricing coming with the higher interest rates that were impacting the pricing of real estate. We, as a good fiduciary, decided not to call additional capital into the fund, only to write it down subsequent to that. So we stopped calling new capital about 2 years ago. And so that new capital, $612 million, we started calling capital in April of this year just because we see a good re-entry point into the market. The repricing that's happened in commercial real estate due to the higher interest rates has largely been priced into the market today. And we think there's a really good entry point into the market given interest rates have stabilized and kind of entered a new normal of interest rate environment. So we called about $200 million of new capital for account purposes. So that contribution queue is about $400 million today. And as an update to our withdrawal queue, so the investors waiting to get out of the fund, a lot of those investors got into the fund about 2 years ago when that repricing started to happen. That's about $1.4 billion today. At the end of the first quarter, we've since paid about $200 million out to investors about a little over a month ago that were impacted by that withdrawal limitation. And future payments to that withdrawal queue are going to be largely disposition driven. Slide 10 gives you a real quick overview of our strategy for the fund. Probably important to note here that we've changed our strategy a little bit. We've been in a pretty defensive investment posture the past couple of years, where we've changed to more of a balanced approach and started to redeploy capital into the real estate markets right now, just as we see the kind of this correction as largely priced into the market, and we see some very good buying opportunities in the market right now. So we're switching to still selling non-strategic properties, but also kind of rebidding or starting to rebid on properties in the market right now, just because we see some good buying opportunities out there, all while maintaining a good quality portfolio, continuing a focus on monitoring and mitigating risk. And there's a lot of things that with commercial real estate investing that we can't control, such as cap rates and interest rates. Things we can control at the property level are just making sure we execute really well on leasing space, managing expenses in this inflationary environment. We've got good track record and a good record of doing that. And so we see a real focus on driving operations at the property level. Slide 11 is pretty self-explanatory, but turning to slide 12 steps through our major 4 property sectors. Industrial, one of our high conviction property sectors. You can see we're overweight industrial. The warehouse business is very good. Right now, it's very strong demand from tenants, whether it be e-commerce or onshoring of manufacturing, or distribution efforts. Very strong landlord fundamentals where we have good, what we call landlord pricing power at the property level. So a number of, this property on the right side of slide 12, it's an industrial property we own between the Orlando airport and kind of the theme parks and the tourist destinations in Atlanta. We built that property a few years ago and we underwrote $6 to $7 rents. We just put proposals out at over $16 a square foot. So very strong rental growth and landlord pricing power in some of these markets for industrial. Our other high conviction property sector is residential. Anything housing related is we see as very strong going forward. It's been impacted by the repricing of the higher interest rates. Housing in general has, and so starts for new residential project, whether it be single family or multifamily, are down. And so we see that a supply glut that's working its way through some of the markets may present a good buying opportunity. And so we're looking at some good residential properties. We've got good diversification with our rental portfolio. It's hard to say there's a typical residential deal within our portfolio. We've got a number of affordable properties, renter by choice, and those are investors or properties that cater to investors or residents that could maybe buy a home, but they choose to rent for lifestyle reasons, typically luxury or Class A type properties. A number of student properties, some manufactured housing and age restricted and single family rental. Office is the most challenging of the 4 property sectors, the large 4 property sectors that we're in. You can see we're underweight. We've continued to sell office. In this portfolio, we had about 47% office as recently as 2015. We've sold about $3 billion of office since then. And so while we didn't see COVID coming, we saw the diminishing returns available from office buildings coming. And so most of that office we sold was pre-COVID. And so we kind of see a flight to quality happening in the office sector, and we think we're going to be well positioned to benefit from that flight to quality. Retail is probably the surprise strong performer in the portfolio. Our retail portfolio is primarily grocery anchored centers. Think of a high volume dominant grocer in a market with a minimal amount of shop space, and that's our typical retail deal. And then we've got, in addition to the 4 large property traditional sectors, we've got good exposure to non-traditional property sectors, manufactured housing, data centers, and single family rental. So those are where some of the best returns are available we see going forward. And so we've got a lead as far as our investment in those areas. Slide 17 is just our largest properties. And then on slide 18, another, we think a competitive advantage for this portfolio is our laddered and even maturity schedule. So we don't have a large amount of debt coming due and maturing in any one year. And that's really been a competitive advantage. It's led to a lower cost of debt capital than our benchmark. So we've got an average debt cost of 4.14%, as you can see there. The benchmark or other funds that we compete against have about a 4.5 to 4.6%. Might not sound like a large advantage, but across a large portfolio like this, 50 basis points is a meaningful amount of spread advantage. We see that as a competitive advantage going forward as well. Slide 20 talks about our returns. You can see absolute returns over the past year are negative, not something we feel great about. We know it's the most underperforming part of many investors' portfolios, but it's largely due to the repricing that's happened as the result of the higher interest rates. So you can see the market type returns or the benchmark return, two measures of the benchmark, the Odyssey equal weight and the Odyssey value weight. We're outperforming the benchmark over all time periods. And so we think that's a testament to the strategy that we've been on, the strong portfolio of properties with very durable cash flows. Some of those competitive advantages like our lower cost of debt, as well as we use less debt than the benchmark. And, you know, debt can magnify returns when times are good, but it also can magnify returns on the downside as well. And so we've benefited from having less debt than our benchmark. And we think another reason for our outperformance is our focus on income. We've really constructed this portfolio with the possibility that interest rates would be higher than they had been over the past several years. What we got wrong is we didn't know that they would rise this much and this far, but we've definitely been preparing for higher interest rates within this portfolio. And so we've got a higher component of our return is coming from income. You can see the measure of our income return at 4.29% annually compares to the both measures of the benchmark by at least 50% or 50 basis points. And so again, we've got that lead in the benchmark, and then turning to slide 21, you see we look to extend that lead over the benchmark in terms of our income growth. We've grown income in this portfolio by a rate twice that of the benchmark. So we've grown income at 6.2%, where the benchmark is just over 3%. And so you can see that's kind of lumpy over years. There's been some big needle movers, but we've got good things in place, and we really have a good forecast of being able to continue that income lead outperformance going forward. And so we think that we're going to kind of outrun the impacts of higher interest rates by growing our earnings or by growing our income across this portfolio. Just some more details on that on slide 22. Just on slide 23 to wrap it up, you know, we largely see this period of repricing coming to an end. We're closer to the end of this than we're the beginning of this, and we think we've got some real competitive advantages to continue to beat the benchmark going forward. We come through this period of repricing. It's been a tough time for commercial real estate. We come through this in really pretty good shape, and we've got some competitive advantages that we see kind of that outperformance continuing going forward as well. We'll maybe stop there and see if there's any other questions.
You say investment, warehouses and storage spaces and whatever. Why is that all of a sudden a big thing?
It's not all of a sudden a big thing, but it is one of the better performing property sectors right now. There are a couple reasons for that. More e-commerce. E-commerce has been a big driver of warehouse returns across the country. Just as e-commerce sales continue to grow and brick and mortar sales have started to tick back up a little bit, but they've been on the decline for the past several years. And so as companies look to improve their distribution networks, warehouse has been a great property sector to be in. So we've had rising rental rates. And when a tenant leaves a large warehouse building, there's very little capital cost that has to go into refitting it for a new tenant coming in, versus an office building where you've got to put sometimes $100 to $200 a square foot just to re-tenant an office building for a new tenant. Warehouse buildings require very little capital improvements. Maybe you might have to put a roof on, and you might have to put some new dock levelers or something like that, but it's very a low capital real estate investment. So we've benefited from strong demand fundamentals, and a lot of cities don't want large warehouses anymore. They create traffic problems. So there's been upward pressure on rental rates for industrial space. So a couple reasons for it, but all of those kind of lead to good investment returns.
Yeah, I've got a question. When it comes to office, we've seen and heard that there's not a lot of transactions going on right now, so there's not a lot of comps. So from a valuation perspective, are we near the end of the write-downs? Is there more pain to come? And what about with your specific properties? Are they close to fairly valued at this point, or is there more write-down expected there?
No, that's the right question to be asking. So maybe turning back to slide 14 in the materials, shows our office portfolio there. And our office portfolio, you're right, there have not been a lot of comparable sale transactions because people investors that don't have to sell an office building are not selling. They're kind of holding on, and if they got long-term leases in play, they're not holding on. So the transactions that have happened have been distressed transactions. So maybe someone loses a tenant or their loan is up or something like that. And so there's been downward pressure on office buildings. So, but without a lot of good comparable transactions of well-leased, high-quality properties, it's been hard for the appraisers to value office portfolios. So in the absence of a lot of good comparable sale transactions, we've actually written our office portfolio down 48%. If you look back pre-COVID levels, 12/31 of 19, we've written with our appraisers, our office portfolio down 48%. Office within the benchmark or the NCREIF index or Odyssey benchmark is only down about 37%. So without a lot of good data, the benchmark is not written down. We've been more proactive in feeding our our appraisers with, hey, we're putting a tenant proposal out for $200 a square foot in tenant improvements. You should include that in your valuation. I don't think all managers are doing that. I don't know, but we've been more proactive. Our appraisers tell us we've been more proactive with recommending further write-downs. And it's not because we have a lower quality portfolio. I think we're well positioned to benefit from this flight to quality that's going on within the office sector. And we've generally avoided a lot of those large gateway cities. So it's important to note the composition of our office portfolio on 14. We don't have anything downtown Boston. We sold actually our small office exposure in Chicago. In New York, we've sold a building, so that has come down in New York. So we're underweight New York. We have nothing in Los Angeles. We have nothing in San Francisco. We do have 2 buildings in Washington, D.C. One is at Capitol Hill. Amazon and AT&T are our largest tenants there. We're about a block and a half from the U.S. Capitol. Flight to quality, we're signing leases at the highest rent levels we ever have. And in a market that's more challenging than anything because the federal government has not called their employees back to the office. So we've got 2 buildings in Washington, D.C., but both are 99 to 100% leased in those 2 buildings. So composition of our office portfolio is a little different, as well as the valuation marks we've taken already. We think we're ahead of the benchmark, and we think the benchmark will catch up to us, but there still is continued softness in office. Lenders don't want to lend on an office building. So it's debt capital is non-existent or very expensively priced, which makes it hard for investors anyone that's got to go before an investment committee is not recommending an office building as their best idea. So it makes getting large transactions done very difficult. So we think we're well positioned to benefit from flight to quality, and we think we've taken the appropriate valuation adjustments in our portfolio. But it's very challenging. But it's a lot like retail was a few years ago. No one wanted to lend on a retail. Rents were falling in retail centers, and now that's the strongest part, of a portfolio, of a diversified portfolio right now.
Darren, the board is acutely aware of the troubles in real estate and valuations have been down. Can you speak as to what your thoughts as to the catalyst for return for real estate will be, whether it be interest rates, whether it be geopolitical and the election coming up? What do you see as the catalyst for us coming out of this?
I think rate cuts from the Fed are really important to give a little clarity to buyers out there that the peak interest rates. We think peak interest rates are in. It doesn't matter to us whether the Fed starts cutting this year or next year, but at least just the buyer psychology and investor psychology is very difficult when they may be grappling with higher interest rates a year from now. And so it's been a very difficult market to sell properties in and for investors to be too optimistic about owning commercial real estate. And so we think the Fed signaling interest rates are lower or they're going to be cutting rates as their next move is a very good sign. And so we think right now the portfolio in the market is priced for this 4.25% to 4.5% 10-year Treasury rate. Just the cutting interest rates by the Fed will be a catalyst going forward. And if the U.S. economy does not go into a major recession, if inflation spikes again and we see higher rates, we'll probably see further repricing in commercial real estate portfolios. But if we see a more normalizing or steepening of the yield curve, as well as the U.S. does not go into a recession, we think that's very constructive and go forward for commercial real estate returns. And we see, development pipelines have been shut off for all property types really, and so we see some supply issues being worked through, but we see some very good landlord pricing power coming going forward, and that's likely to be a very strong catalyst for real estate returns, as well as just more buyers kind of getting off the sidelines. And we were talking in the library earlier coming in here, and it seems like the spot market or the investor market has really bottomed out already. There's some valuation things that are working through the system a little bit, lags working through the system, but we're out actively bidding on new properties to acquire, and we think the bottom is in, and there's positive investor activity for new acquisitions. So we think, lower interest rates will be the biggest catalyst for real estate returns. And so bond portfolios as well as real estate portfolios will benefit from the first rate cut and continued rate cuts.
Further questions? Thank y'all.
Thank you.
Thank you for your business. We appreciate it.
I bet it was a bull shark.
All right.
Good afternoon.
Good afternoon. Dr. Ramsey. I know the doctor.
Last but not least, we have UBS with two funds, TPF and TPG. I'll turn it over to Julie.
Yeah, absolutely. Well, thank you first of all for having us here this afternoon. It's nice to see you all. We appreciate the invitation. My name is Julie Piero. I'm an investment specialist, and typically you would be having Tom O'Shea here. He apologizes. He's unavailable. I'm here in his place. But I promise for the next 20, 30 minutes or so, you're going to have a very riveting and terrific update. You're going to be hearing from Paul Canning. He's going to give you an update on the state property fund. And then you're going to hear from Derek and Mario. They're going to talk about your investment in So without further ado, let me hand it over to Paul.
Thanks, Julie, and thanks for the opportunity today. I've had the opportunity to come visit the Board of Directors here since 2010. First as Portfolio Manager for our Growth and Income Fund, and then more recently as Portfolio Manager of our Trumbull Property Fund. And I do have to acknowledge that my unblemished record of remembering my sports jacket was lost this week, and I feel a little vulnerable, but that's a first. For commentary today, what I thought we would offer you is a very brief setting the stage on commercial real estate market, talk about Trumbull Property Fund portfolio positioning, our performance, and sort of where we see the fund going forward. Before we get into our remarks, are there any areas, Jason or others, that you'd like us to focus on outside of what we may have referenced already?
No.
Okay. So setting the stage, just a couple high-level comments. So commercial real estate market peaked just about 2 years ago, second quarter of 2022, coincident with very low interest rate environment and strong expectations for market growth. Our trailing returns at that point were 20% plus on an annual basis, and everything looked terrific. Obviously, things have changed, particularly with the cost of capital that's available to support a capital-intensive industry, which commercial real estate is. Transaction volumes currently are very low compared with historical activity. I would just sort of point that out on slide 15. And by the way, obviously, we've given you all quite a bit of content here in terms of slides. We'll just touch some highlights. But the bar chart on the left looks at quarterly transaction volumes, and you can see that peak coming out of the very favorable market conditions of 21 and 22 dropping off, so that transaction volumes were half last year of what they were the previous year. And then even into this year, we've seen sort of declining transaction volumes. So that's really a function of the market not connecting and trying to sort out the new cost of capital that we're reflecting, and the anticipated moves of the Fed in terms of adjusting short-term rates. Interest rate changes are going to dictate the pace of value recovery that we can expect from our real estate funds, and it's really just math at this point in terms of the cost of that part of the capital stack. In terms of our fund values, I'd say that appraised values will continue to be under pressure in 2024 as appraisers reflect or attempt to reflect the impact of the higher cost of capital on real estate values. So with that said, let's just talk about Trumbull Property Fund. I'm going to glance across a couple of slides, but I am looking at slide page 22. I think, as you would all recognize, Trumbull Property Fund is a core real estate fund, so we are intended to provide you with a diversified allocation of durable property investments that are characterized by strong leasing and, at the fund level, low leverage. And you can see that in the high-level statistics for Trumbull Property Fund: 124 properties spread out over a variety of property types and markets, 92% leased across the entire portfolio, less than 6% in value-added properties, which would be higher risk properties, and a relatively low leverage of 22% at the fund level. So let me then take you with that background to how we are achieving the allocations that we desire for the fund, and a little bit of the evolution of the fund over time, because I think a lot's changed in commercial real estate and how we're investing on your behalf. And I'm going to reference slide 24 here. The time period on the donut chart at the top is our allocations by property type in mid-2018. That was the point in time when I became portfolio manager of the fund. And then we're looking at our most recent allocation at the end of the first quarter of 2024. And I think it's really clear from these charts to see the predominance of office and shopping centers in 2018, where combined this was about 53% of our fund assets, and the diminution of our reliance on investing in those sectors where they're now less than 20%. And you can see that in the brown and blue portions of our allocations. Where we've seen allocation growth certainly and most dramatically is in the industrial sector, where our exposure has increased by probably about 2.5 times, and that's a result of both appreciation and acquisition of properties into that sector, which has seen such a strong demand surge for industrial properties. And then for Trumbull Property Fund and for our investment platform in general, a heavy reliance on multifamily properties. We have always liked the persistent demand for apartments and the low capital that's required once a property is built to maintain the cash flow that we anticipate from each of our apartment properties. On the right, we take that lower bar chart and now compare our allocations with the index that we measure our performance against. That's the NCREIF Odyssey Index. And our allocations are in the light brown, the index is in the dark brown. And you can start to see how we're positioned somewhat differently than the index, with a significantly higher weighting to multifamily. We're just about on allocation with industrial, a significantly lower exposure to office, and currently a lower exposure to shopping centers, with an increasing investment in life science properties, somewhat replacing some of that office allocation that we've had in the past. In terms of fund performance, the good news for Trumbull Property Fund is that over the past year, we outperformed our index by 121 basis points. And when we look at our attribution of our performance, we can see that about half of that outperformance came from the fact that we were lower levered in a declining value environment, and about half of it came from our property performance and investment structure on how we hold those properties. So a balance of where that outperformance came from. As we've talked about earlier, obviously we are in a period of absolute value declines that reflect sort of the cost of capital. One of the things that is not so evident when you look at these return series is that for most of the commercial real estate industry, property performance actually has been pretty good. So if we're going to take office out of the picture for the moment, generally speaking, we've had in our valuation, the process, the benefit of expectation of growing cash flows coming out, specifically out of our apartment and our industrial portfolios. So on the operating level, the largest segments of what we're invested in are doing well. They're well leased. We're able to grow income and deal with the current levels of supply, but we're really in a capital market situation that's driving these value adjustments. So in terms of where we stand today in terms of the fund's capital, and I'm now referring to slide 26, the fund does have a redemption pool. We are working to manage liquidity for investors who seek it and provide capital for the portfolio needs. So that's sort of a balance that we need to undertake sort of every quarter as we move forward. I'd say that sort of the predominance of redemption pools is an industry issue currently, as capital has retreated for commercial real estate until the point in time when we can all see and feel the bottom. But it will come back, that's certain. It always does. And for Trumbull Property Fund, we have a clear plan going forward about how to address redemptions and operate the portfolio on your behalf. In terms of the pace that we'll execute that at, we do need the market to return and that level of transactions to come somewhat nearer to what it's been historically in order to execute effectively on your behalf. The next couple slides lay out where we're taking the fund in terms of the investments that we would anticipate making, the sales that we would execute as part of our strategy, how we're handling leverage, and where that takes us to in a couple of years. So this is our chance to, at a very granular level, roll up all the cash flows that come from our properties, think about the investments that we want to hold, where we've got holes in our portfolio, where we'll fill those holes, the use of leverage, and how investors will behave. And it's a very comprehensive look at a large fund and quite a bit of activity. But I like to show it because I love to get in the weeds, which maybe y'all don't. But there's a lot of thought that goes behind it in thinking about, where do we go over the next couple of years as the market returns to, I'd say, a more normal set of conditions. And so I'm not going to go through each of these pages, but on 28, we talk about our planned disposition activity. And I think the key point here is that we're identifying properties that we think are going to be less helpful to us going forward than the remaining portfolio that we'll hold. And we're thinking about both individual property performance and our allocations by market and property type in making those decisions. We do reserve capital for portfolio investments, so we need to continue to invest in the large portfolio that we own. That's building improvements and leasing capital and commissions. And then we have a series of acquisitions that we would intend to make over time. Our tilt on the acquisitions is going to be more into alternative sectors, so we're definitely seeing the expansion of where core real estate is going, and I'd say that reflects the dynamism of the American economy. So we want the built environment that we're invested in to pick up, where demand is going in terms of allocating by property type, and we want to be light where demand is retreating, with the most obvious example that being the office market. In terms of leverage, we have talked about being a low leverage investment vehicle. We will continue to do that, but on the margins, we have a tactical opportunity. Leverage has been good for us in the period of declining values, but we will get to the termination of that. And at that point, we do want to moderately increase our leverage, and this page is our expectation of what that looks like, with a target of about 30% leverage as we go forward. The index, we've got it quoted here at 27%. That's a year-end number. I think it's closer to 28% right now. So when growth returns, we don't want to be under-levered because we're going to give up yield if we hold that position at that point in time. And then in terms of our existing book of debt, that $590 million of maturities in 2024, when we report to you at the end of the second quarter, that'll be a $30 million. So we've resolved or executed extension options on $560 million of debt that we had by right, and pushed those maturities out into the future. So let me conclude on slide 31, and this expresses sort of what we want this portfolio to look like, and our actions are all sort of driven to solve in this fashion. And so we're looking forward 3 years, and we're looking at where our allocations might be, where our leverage might be, what the components of the portfolio, and how it breaks down by market. And I would just make a couple of points out of this. Number one, we'll be 70% allocated to apartments and industrial. So these are the sectors of commercial real estate that are by far the deepest in terms of capital markets and have the most evident and persistent demand for properties. Our retail allocation will be about 10% of the portfolio. We'll be very light on office buildings. We've been a seller of office buildings, which is why we have a lower allocation today. We will continue that. And then we'll look to be about 15% allocated into some of these niche properties. Certainly life sciences is an opportunity that we've already invested in. Jason was kind enough to visit our Cambridge side property earlier this year and saw a little bit of our execution there, developing contemporary life science in a transformed property in the heart of the life science world. That's East Cambridge, Massachusetts. But we'll also look to expand that niche in alternative investments, investing into self-storage, and then some other areas of opportunity that are likely to relate around affordable housing and some of the different manifestations of that. So, I think in summary, we feel good about the repositioning that we've been able to show you, the path that we've been on the past couple of years, and today's departure point on where we can go with the fund going forward. We're constantly thinking about sort of the execution of that plan. Clearly, we need the market to show a little more vigor, buyers to regain the animal spirits that seem to be missing right now. But I think we're in a good position as we look forward and anticipate sort of the return of appreciation in the sector to benefit with our allocations and plan for Trumbull Property Fund. Let me stop there. I'm cognizant of time. Jason said we're the last ones keeping you from the end of the day. I prefer to think we're hitting cleanup, but let me not take too much liberty with that.
All right, thank you, Paul. And again, thank you for trusting us to be your real estate manager in Trumbull Property Fund. You all have been an investor for over 20 years, so we appreciate the opportunity to invest on your behalf. And with that, I'm going to turn it over to Mario and Derek to provide you with an update on Trumbull Property.
Thank you, and if you were second to last, we're definitely not. So good afternoon, everyone. So this is actually my first time presenting to this board. My name is Mario Maturo. Sitting next to me is Derek Zankowicz. We're the portfolio team for Trumbull Property Growth and Income Fund. I realize that there's been a lot of presentations today on the real estate market, so we're going to really focus our comments on our fund, kind of what differentiates our fund from other funds, and then where we see outperformance in the future. Our presentation starts on page 70 of the book, and we're going to try and flip along through the pages as we're talking. Hopefully it'll be as concise as Paul was. So TPG is an open-ended core plus fund. I like to call it an infinite life cycle fund. It's invested across multiple real estate sectors, and it's really positioned and invested both to provide growth as well as income. And we provide that growth and income by deploying leverage and using value add investing to really outperform the Odyssey benchmark. From a strategic perspective, we're definitely overweighted towards real estate sectors that we think have kind of a low ongoing capital expenditure, but also have very strong enduring demand drivers. And then tactically, we look at other sectors where we think there's really a story where we can generate some outsized returns, either a thematic story or maybe a unique situation where we can capture some of that upside. From a location perspective, the fund has historically been overweighted to high growth markets and coastal markets, usually in the West and in the South. And I think today, like going back to the differentiation, what we really want to convey is there's like 4 key areas where we differentiate ourselves. So it's our risk profile, it's our strategy in owning property levels at the ownership of the property, it's our use of leverage, and then it's also really our concentration in a couple sectors. So at the end of the first quarter, the gross assets of the fund were just over $1 billion. They were diversified across 23 individual property investments, and those property investments were across about 7 different property sectors. The portfolio is currently well leased for a core plus fund. It's around 85%, and we're holding a little bit higher than normal cash at the fund level. We're at about 6% of gross assets, and we're doing that because we have some upcoming debt maturities. We've done well refinancing debt maturities, but we want to have a little bit of cushion in that regard. On page 71 of the book, we do show on the right-hand side our current risk profile of the fund, and we compare where we are today to our long-term target. So over the long term, our target is really to be about 40% invested in value creation assets, and then about 60% in core assets. And so the value creation is really creating that growth for the fund, and then the core allocation is to provide more of a stable income. Today, we're at about 30% exposure and 70% exposure. I think that's appropriate given the near-term risk in the market, and we've really had that lower exposure throughout 2023. But from a differentiator perspective, being 30 to 40% in risk assets versus a typical core fund is about 15%. That's really how we're able to generate higher growth in appreciating markets. Now, I do think as we enter what we're expecting a market expansion, we will move that 30% to at least 40%, if not above in the near term, to really capture some of the capital growth that's coming.
Yeah, and I think another key differentiator for our fund is our targeted sector allocation, which we show on page 72. Mario said it earlier, but we strategically overweight to real estate sectors that have enduring demand drivers and this low ongoing capital expenditure needs. And because of that, we've always overweighted our fund to the apartment sector. The long-term investment target for apartments for us is about 45%. We're sitting a little bit above that at 48%, but we feel like we're in a generally good position in that regard. While the apartment sector has seen some repricing in 2023, there's still very good operating fundamentals. I think that's evidenced by the 92% lease percentage of our portfolio. And there's some very positive near-term growth prospects. So some of the demographic trends that we're seeing, the low home affordability kind of support ongoing demand for apartments. And I think you couple that with limited near-term future development pipeline, and that creates a really long-term kind of tailwind for the apartment sector. In addition to apartments, we've also concentrated on trying to overweight to industrial and severely underweighting to office. Industrial is one of these kind of low capex sectors that Mario was talking about, and a sector that's really benefited from the growth in e-commerce over the past decade or so. And we think that's going to be further bolstered by some of the near and reshoring trends that we're seeing. Office, on the other hand, is a very challenged property type, as I'm sure all of the fund managers have kind of expressed. It requires a significant amount of capital, and the existing vacancy before the pandemic has kind of been exacerbated by these remote and hybrid trends that we're seeing. And so there's been a kind of severe drop in demand. TPG has a 24% allocation to industrial and only one remaining office investment, which represents about 4% of our gross asset value. I think very importantly, having 72% of our fund's GAV invested in apartments and industrial and only 4% in office really positions us a lot differently than some of our competitors, and we expect this to benefit our investors both in the near and long term.
Thank you, Derek. If we could turn to the next page, our TPG leverage page, it's page 73. So I think there are two other areas that we wanted to point out where we think we're a little bit different. The first is the use of our leverage, and the second would be, I brought up earlier, it's our property level ownership strategy. So from a debt strategy perspective, we definitely deploy higher levels of what we call flexible leverage to enhance our portfolio returns. And then on our ownership strategy at the property level, we almost exclusively as a fund invest through joint venture partnerships. So that means working with regional developers and operators in all of our executions. So on the debt side, obviously in periods of appreciation, the leverage enhances our returns. Our long-term target for the fund is about a 50% leverage ratio. We're currently around 46%. Unfortunately, we are in a period of the higher cost of debt, lower lender liquidity. That has negatively impacted our fund. It put some definite pressure on the fund today. I will say throughout 2023, when rates were going up, and the first part of 2024, we've been able to manage our debt maturities, and we've actually brought our overall cost of debt down from its peak, I think, in the fourth quarter of last year. From the property level ownership strategy, I think this is a very key strategy. And so I think it's 90% of all of our investments are through joint ventures. I think there's only 2 investments that are wholly owned in our portfolio. And we as a team feel that it's very important to partner with local operators who understand the markets on a street-by-street basis. They are experts in both the sector and the market, and we think that really enhances our ability to generate return, make buy and hold decisions better, understanding the market and working with them. So going forward, our plan is to continue our leverage where it is. I mean, we're slightly under 50%. I think we'll probably stay right around where we are now. And then the new investments that we're looking at, we're continuing to look at doing more partnerships with regional operators, especially on the development side. We're looking at several properties right now, and it's with developers we've worked with in the past. If we could turn to the next page, I think it's page 74. So we do want to talk about our relative performance. I'm sure everyone's talked a little bit about their performance. So I'm not going to dwell on the challenges of the market and how real estate has experienced a lot of declines. I mean, obviously, 2023 was a negative year. The first quarter of '24 was negative. I think most groups are probably trending towards a slightly negative in the second quarter. TPG is no different than anyone else. We've experienced that negative appreciation. For the first quarter, our negative return, total return was 2.6%. Odyssey's negative return was about 2.4%. So our gap has narrowed on a quarterly basis. But if you look at our trailing 1 year, we were around negative 18%, and Odyssey was around negative 11%. Obviously, it's very disappointing to us to deliver negative returns. We don't think we're unique in this environment delivering negative returns. The only thing I like to maybe point to on the positive side is when you look at Mississippi's investment in our fund, Mississippi's been invested with TPG since 2011, so a few years after investing in TPF. Over that time frame, so that's about a 13-year time frame, through some very smart contributions and withdrawals by the team here, Mississippi has been able to generate a 8.5% annual return throughout that entire period, including this pretty strong negative period. And that's almost a 2 multiple over that time frame. So while this last year has been very disappointing, I think overall from an investment, it's been fairly consistent.
Yeah, and maybe we can provide a little bit more context to the recent underperformance. On page 75, we did conduct an attribution analysis to help kind of understand what's driving our relative performance. And it kind of breaks down TPG's returns into kind of 3 main components: direct real estate performance, the impact of leverage, and another kind of catch-all category, which includes some fund level G&A expenses, cash held at the fund level, and then investment structure. You can see that TPG's direct real estate exposure has really only slightly underperformed the benchmark, and I think that's more than offset by the partnership structure. So some of our joint venture partners being in a first loss position in a depreciation environment. And we've also had some cash investments that have positively contributed to our relative performance. I think what this chart does a really good job of illustrating is that TPG's underperformance over this 1 year time frame has really been fully driven by our higher leverage position. Leverage has been probably the biggest negative contributor because our leverage level is quite a bit higher than the benchmark. It's almost double. So where TPG is levered at 46%, the benchmark is somewhere between 27 and 28. And I think Mario may have said this earlier, but leverage is a bit of a double-edged sword. It enhances returns in periods of appreciation and kind of amplifies those losses in periods of depreciation.
Thank you. So I'm aware of the time. We just have one more slide that we wanted to walk the group through. It's on page 76. So this is a different look at returns. And I think it's important for a core plus fund to look at it from an annual perspective, not just a cumulative looking back, because a lot of times one bad year can really impact all your historic returns. So this chart on page 76 shows all of TPG and Odyssey's returns dating back to 2006 when the fund was created. Obviously, Mississippi wasn't invested all the way back. A couple things to point out. I think if you look back the last 10 years, TPG has outperformed the Odyssey 8 out of the last 10 years. And many of those years, I think 4 or 5 of those years, TPG has been able to deliver on a gross basis returns higher than 20%. And when you look at that, when you look at the chart, you'll see there was a major repricing in 2008, 2009 due to the GFC. And you'll see that on a historic basis, after that repricing, there's been some pretty significant outsized returns. And, I think we believe here that, we're kind of on the cusp of another market expansion. We believe the downward pressures that Paul was talking about on values is really coming to an end. We think interest rate increase concerns are really dissipating. And we also think investors are starting to price in future relief. So, again, we think there's a potential for some outsized returns coming after this 2023 downturn. And we want to make sure that, we're focused on that future performance, capturing that future performance. We think it's a combination for TPG of leveraging our current portfolio positioning, being overweight to apartments and industrial, but then also doing some very tactical dispositions and new investments to really capture the growth in the cycle. You couple that with the higher leverage that's been hurting us, and now if we get to a positive return, that's going to help us perform better than the benchmark. So I'm going to stop there. I know it's been a long day. We have a lot more slides that we can get into detail about dispositions or investments or anything else, but maybe it's best if we just take some questions.
Mario, I'll direct you to page 72, portfolio positioning, sector allocation and regional allocations. On the niche sector, can you help us understand what those niche sectors are and how you're going to get there? And the same thing on the regional, on the east, are there any markets in particular that you're focusing on in that on the eastern seaboard? And again, how do you expect to get there?
Sure, and maybe we could turn to an appendix slide that might help answer that question a little bit. Let's see, if you go to page 84, so this talks about our investing targets. We are light, let's talk about region first. We are light in the eastern region. We've actually been looking at some interesting developments in the Boston market, and you'll see in the second column our target markets. So Boston is one area that we don't have any investments in. We'd like to be there. We think there's some really good demand drivers there in the apartment sector. From the niche sector perspective, what's included in the bucket now is 2 self-storage properties and a hotel property. We have and are looking at more self-storage properties. We have a partnership with a group called Baranoff. I think, Paul, you have a couple or at least one investment with them as well. So we want to leverage that existing relationship to find opportunities in self-storage. We don't see a near-term opportunity on the hotel side. I think hotel is a very high CapEx sector. Almost every 7 years, if you own a hotel, you have to spend a significant amount of capital to really reposition it. So I don't think we'll be investing any more in hotels. I foresee self-storage being one of the main categories, but talking about demand drivers, senior housing, we have one senior housing investment right now. I think demographically, senior housing is going to continue to be in high demand and continue to increase in demand, so we're looking at senior housing as well.
Quick question, Paul. Can you just maybe walk us high level through the mechanics of how does the relatively outsized redemption pool kind of hamper your ability to continue to reposition that portfolio? Like, in other words, does disposition activity get a first call on the redemptions, or can it be set aside for new investment? Like, how do you make those determinations?
Yeah, so there are a couple of guidelines on how we operate that are built into our offering documents to investors. So in terms of the use of capital that we might generate from any type of activity, sales, new deposits, additional leverage, first call is to support the existing portfolio. So if we have capital needs, those get the first call so that we can protect the investments that we're invested in. And then we have a relatively simple requirement that sort of every quarter, 50% of our available cash needs to at least 50% of our available cash needs to be utilized to fund redemptions when there are redemptions that are outstanding. So it's a fairly straight mechanism. I think it's clear to investors and easy to explain.
So there's some capital left over to continue to put to work and use to reposition the portfolio.
Yes, that's right.
As you showed, you've made great progress, but there's still ways to go in terms of where you want your targets to be.
Right. So, for instance, we're, today, obviously, we're looking at sales opportunities. We're in the market across the country and at a variety of sectors, trying to find that place where investors will be most aggressive. on the sales side. And interestingly, we found it in the multifamily sector, really in 2024, where investors are willing to bid to prices that would have them incur significantly negative leverage compared to where they can borrow today, which is not the dynamic of 2023. Everybody was looking for accretive leverage. That meant that sort of nothing happened. We now are seeing some green shoots where we've got investors who are believing in the long-term story and are willing to, bear the cost of more expensive leverage than the total yield on the property in the near term. So that's a place that we're starting to connect with the market, and have got properties that are now under agreement to close and provide some liquidity, and we'll follow through with additional offers of that type of property based on that success. That gives us capital then to consider where we might go, and the next things that are in our sights are in the affordable housing realm. So it's sort of taking capital that was invested in sort of downtown high-rise properties and thinking about some other ways to be invested in the residential sector. That's sort of the very near-term sort of trading that we're looking at.
Any other questions? Thank you, ladies and gentlemen.
Thank you.
Thank you all.
Thank you.
Jason, thank you for your partnership.
Is Marathon, wow, that got loud. Simon Somerville, their Japanese portfolio manager, has announced that he's planning on retiring. No real concerns here. Mondrian has a real deep bench of portfolio managers. They manage the portfolio with different sleeves of different portfolios that are then aggregated together. So his portfolio is going to be distributed to a couple of other, very well-seasoned portfolio managers. And then the other item is with Fisher Investments. Ken Fisher has sold a minority share of his company to a Dubai asset manager. It's just being done as a way for him to for estate planning purposes. He's still maintaining a 70% share of voting shares of the company. So nothing's going to change with, our portfolio and how it's managed. It's just, for Ken and his estate planning purposes. And if there's any questions, I'll take them. Otherwise, I have nothing left for today's agenda.
Any questions? Well, the investment committee will stand adjourned.
Thank you.